Chapter 21, we will talk about cost, volume, profit analysis. So here are your learning objectives. Cost behavior is trying to explain how costs go up and down, and there's things that cause that change. So there could be activity bases that push the costs up or bring them down. And we always say the costs change within a relevant range. So say if my production, if I'm operating within the confines of my factory, as long as I remain in the confines of that factory, my sales can go up and down. If all of a sudden my sales boom, like exploded, and I had to have two factories, then I'm outside of my relevant range because again, it's way bigger than expected. So what we're going to talk about is variable costs, which go up and down as your sales volume goes up and down, fixed cost, which will stay the same as your sales volumes go up or down, and then mixed are a little bit combination of both. So a piece of them stay fixed, but a little bit will go up as your sales go up or down as your sales go down. So again, the variable costs will change along with your sales or your production. And so the most common variable costs are direct materials and direct labor. So if I'm building that guitar, the direct materials that go into that guitar, if I sell 10, obviously I'm going to have, 10 versus 100, obviously I'm going to have a lot more wood and strings and things that need to go into that guitar, direct materials. And then I'm going to have a lot more labor that has to assemble those 10 versus 100 guitars. So they'll go up per guitar. So then here again, they're kind of showing us that if it's $10 per unit, if I have 5,000 units, I'm going to have $50,000 of cost. If I have 30,000 units, I'm going to have $300,000 of costs. So for each unit I produce, it goes up by that 10 bucks. So the characteristics is, again, the cost per unit, like that $10 per unit, that remains the same. What goes up is my total. It goes in proportion with my units sold. As my units sold go up, I go up by 10 bucks per unit. So here shows you, again, graphically to say, again, with each unit, I go up by the 10 bucks. So it's just a straight line going up. My costs go up as my material or my units go up. The unit cost is the exact same. No matter how many units I produce, it's still 10 bucks a unit. So things that are variable, like if we're looking at our universities or our colleges, our instructor salaries. So those are tied to our number of classes. As our number of classes go up, we will pay more instructors and we'll have more instructor salary expense. If we go down to manufacturing, again, we already talked about direct materials. Those are tied to our number of units produced. As we produce more units, our direct materials go up. Go down to the bank, our teller wages will go up with the number of banking transactions that we do. Fixed costs, again, like I said, are ones that are going to remain the same dollar amount no matter what like our sales levels are. So here we have, again, within that relevant range. So if we have total fixed costs of the manufacturer's side of the business at $75,000, it's not going to matter as long as we stay within this production level. Because like I said, if we go with this example, if we would go beyond 300,000 bottles of perfume, we would probably have to get a new facility or an additional facility in order to be able to do that. So as long as we're within that range, our fixed costs are $75,000. Oh, and in this case, it's the salary of that employee. So if we went beyond that, we'd probably have to have two people that were going to work because that's the capacity for this person's salary. And then, so again, the cost per unit is going to change because it's the same dollar amount. And if our units, our activity level changes, that's going to increase or decrease. So as we sell more or produce more, the cost per unit is going to go down, but the cost itself stays at that $75,000. So here it is on the graph with our units, again, within that relevant range, it's going to stay 75,000. if we're looking at it per unit, it's going to go down as we get to those higher number of units that we produce. So examples, again, going back to the university, it would be the building that the classes are operated in. So that's going to be the same amount, whether we have only 2 rooms using or we're using every single room in the building. Then go down to our manufacturing is the example we just had, that plant manager's salary. It's going to be the same whether we're producing the 5,000 units or the 300,000 units. Then down to the bank, it's the bank manager's salary, and it's going to be the same whether we have 100 customers or 3,000 customers. Then our mixed costs go a little bit in both directions. They have parts that are considered some semi-fixed and then parts that are a little bit variable. So examples of that would be rental charges of a machine. If we pay a set amount per year plus a dollar amount for each hour over 10,000, so the 15,000 a year covers 10,000 hours. Every hour over that, we pay another dollar. So as long as we're under the 10,000, we're just paying $15,000. As we go beyond that, again, we have our fixed piece plus our variable piece, the hours over 10,000 times the dollar. So that we can see at certain levels, it's going to remain at that 15,000. Then when we cross over the 10,000, it goes up per unit. The high-low method uses our highest and our lowest activity levels to estimate their costs. So they give us a total, so if we look at this graph, our lowest level is the $750, and we have a cost of $41,250. Our highest level is 2,100 units at $61,500. So then we're going to calculate those out to come up with the difference. So we've got 1,350 units between our high and our low, and then the cost associated is $20,250. So then we will take the difference in the cost in the units to come up with an average per unit. So then we'd have $15 per unit. So then our actual costs are going to be our total costs at that high level minus the $15 per unit times the 2,100 units that we produced. So then our fixed cost is $30,000. And then at the lowest level, our costs were $41,250. Taking the $15 times the units produced gives us a variable cost of $11,250. So then we see that we've got fixed costs that are $30,000, and then for every unit produced, there's going to be variable costs of $15 per unit. And then we can use that as our formula to estimate how much our costs will be. So then if, let's say we have the 2,000 units, we're going to put the $30,000 fixed costs plus $15 times those 2,000 units. So then our total costs are going to end up being $60,000, or our estimated total costs. So we can use those kind of formulas to kind of plan for the future and estimate what our costs would be. So then again, here is an example. So I'll let you guys look that over on your own. So then our variable and fixed cost behavior, our variable increases or decreases with our activity level in total. Our fixed remains constant in total, but the per unit of the variable remains constant, and the per unit of the fixed increases or decreases with the activity level. So again, they give you examples of each one. And then a summary of the concepts. Okay, so then our next topic is our cost, volume, profit relationships. So then we're going to talk about our selling price, our production volume, costs, expenses, and what our profits end up being. And we're going to have some formulas that'll kind of help us make some predictions. So then why do we use these? We may want to analyze, what if our selling price, what if we increase our selling price? What's that going to do to our profit? What if our costs go up, like our variable costs, our direct materials or direct labor? What does that do to our profit? What if I sell more? So all of a sudden I get a new customer, my sales go up 10%. Again, and it helps you kind of determine what you need to set those selling prices at, especially if your costs are changing. So like say those direct materials or direct labor costs are going up, you're probably going to want to adjust your selling price. So all those things are kind of what we use these cost volume analysis for. So the contribution margin is a little bit different than our, like say our profit margin or our gross profit margin. Our gross profit margin we've had in the past is your sales less your cost of goods sold gives you gross profit. Now we go to say, okay, we're going to just focus on our type of expenses. So our sales less our variable costs. So again, remember our variable costs are the ones that go up with each unit that we sell. So our direct materials and our direct labor are variable costs with each unit that we sell. So here they give us some data. If we have 50,000 units at a selling price of $20 per unit with variable costs of $12 per unit, and then we have fixed costs. So again, like our salaries and our depreciation and our rent and all that stuff goes into our fixed costs. Then if we want to put it into a contribution margin income statement format, it would be our sales of 50,000 units times our selling price of $20 for $1 million. Our variable costs, the 50,000 units times the $12 per unit, so 600,000. And then subtract those, we have a $400,000 contribution margin less our fixed expenses. We have a profit of $100,000 or income from operations of $100,000. So then if we would then increase our number of units sold, that's just going to increase our income because the fixed costs are already covered. The contribution margin ratio is the contribution margin divided by the sales. So 400,000 divided by $1 million gives us a 40% contribution margin. And then we can use that, again, once we've crossed over our fixed cost to say, if our sales go up, what's that going to do to our income? So if our sales go up $80,000 and we have a 40% contribution margin, our income is going to go up $32,000. Because again, our direct materials and our direct labor go up right along with the sales, but we've already covered our fixed costs. So all of that extra is going to go right into our bottom line or our net, our operating income. And then here again, it shows it mathematically, so you can see that it does increase it up 132,000. Okay, so then now we have an example. If they have a high contribution margin and they are producing below 100% of their capacity, a large increase in their income could come from an increase in their sales volume. So they may try to then market and increase their sales. So they know that they're already covering their fixed expenses. It all is going to go right into their income. And then sometimes we'll get into just, so those were like the full dollars amounts. Sometimes we'll have it like a per unit basis. So what's our selling price per unit minus our variable cost per unit? So then we have a contribution margin or a unit contribution margin. So for every unit that we sell, we're making $8 that will help us cover our fixed expenses and then eventually provide us with profit. So then this is another way to look at it though, to say, okay, if I sell 15,000 more units and I've got a unit contribution margin at $8, my change in income is going to be 120,000. If I've already covered all my fixed expenses, then that just goes straight into my income for operations, which we can see here when you put it into the contribution margin income statement format. You can see that that's how it does work out. and then I'll let you look at that example exercise. Then we can also calculate our break-even units in sales. So our break-even is saying how many units do we need to sell to cover all of our costs. So our variable costs and our fixed. No profit, just breaking even. So we take our fixed costs and we divide it by the unit contribution margin. Because remember, the unit contribution margin is our selling price minus our variable cost per unit. So we're already covering the direct materials and the direct labor. So what's left, we're dividing into our fixed costs. So that's how many we would have to sell to cover all of those costs or to break even. So with this example, we have $90,000 of fixed costs, selling price of $25, variable cost, again, direct materials and direct labor of $15. So we're making $10 per unit. If we take the 90,000 divided by the 10, we'd have to sell 9,000 units to break even. Anything over the 9,000 is going to provide profit. So then again, here they show it in the income statement form. So you can see income from operations is 0 if we sell the 9,000 units. Okay, so then we can also, if we don't have it in the units, if we have it only in sales dollars, we can take our fixed cost dollar amount and divide it by our our contribution margin ratio. So our contribution margin ratio was 40%. Divide that into our $90,000 of fixed costs. Our break even in sales would be $225,000. And then again, like we know, the fixed costs do not change based on level of activity, but other things can change our fixed expenses. So property taxes can go up. We can give a raise to our supervisor. We can make some change to our advertising campaigns. So all those things can change. It just isn't related to our units sold. But if fixed expenses go up, then obviously we got to sell more to cover them, so our break even goes up. If fixed costs go down, we can sell less, so our break even goes down. So then we run through some potential changes. Okay, so what if we want to increase our advertising budget for $100,000, so our fixed costs are going to go up to $700,000. So then obviously we're going to have to sell more, but hopefully with the advertising campaign, we're able to do so. So our break-even point prior to the additional advertising campaign was 30,000 units. When we spend the additional 100,000 for that advertising, now it goes up to 35,000. So we would want that advertising campaign to definitely result in more than 5,000 units to actually have it be money well spent. Now, our variable costs per unit, they're the direct materials and the direct labors, those can also go up due to increased cost in direct materials. A lot of times we're buying those from vendors. Things happen in our economy and prices go up. Maybe we're giving a raise to all of our factory workers, so our wage rate for direct labor goes up. Maybe commission paid to our salespeople is going to increase. So if our unit variable costs go up, then our break even goes up. If for some reason those would go down, we all of a sudden get better deals on direct material, then our break even would go down. So then here, if we are going to give an extra 2% commission to our salespeople to try to get them to sell more, that's going to increase our variable costs. Our selling price is staying the same, but our variable costs are going up. So then our unit contribution goes down, and then we then would have to sell 400 more units. So that commission incentive has to at least provide more than 400 units to make it worthwhile. Then we could also change our selling price. So if our selling price goes up, our break-even price goes down. If our selling price goes down, our break-even price goes up. So if we are thinking, okay, we're going to increase our selling price by $10, and if our variable costs stay the same, Now we're making $30 a unit. So then we maybe used to have to sell 30,000 units. If we bump the price up, we only have to sell 20,000 units to cover our costs. So then this gives you a nice little summary graph of what, if those go up, what does that do to my break even? If those go down, what does that do to my break even? And then they'll let you look at that example. But obviously we are in business to make money. Even not-for-profit companies are in business to make money. They just don't pay it back to their shareholders. They don't have shareholders. But so there's always a targeted profit. So we want to figure out how many units we need to sell if we not only have to cover our fixed costs, but we have a target profit that we want to get. So if our fixed costs are 200,000, our target profit is 100, we want to make $300,000, and we have a unit contribution of $30 per unit, we'd have to sell 10,000 units. So then that becomes our goal to get that target profit. And then again, here it shows you in the income statement format. We could also, if we don't have it per unit, we can use that contribution margin ratio. So the 300,000 is what we want to make, divide that by the 40%, and we'd need to have sales dollars of 750,000. Okay, then they chart this out. So sometimes people like to see charts. Sometimes other people are not real thrilled with charts, but let's see if we can get to where they actually kind of show us one. So here it is. So we've got where these lines cross. So this bottom line here is our total sales. So it's going up. Then the top line that again, as it goes down over here. But that top line starting over to the left is our total costs. So there's a period of time when we're not selling enough units that we are in that operating loss area. Our total costs are less than our sales, so we're losing money. Then where those two lines intersect, that's our break-even point. So again, those are the units of sales or the sales dollars where we're covering our direct costs and then our variable direct costs and our fixed costs. Then if we keep going beyond that, then our sales are going to be above our costs and we're actually going to make money. So anything over that break-even point, you start to enter into the profit. Okay, so again, they're just kind of explaining that out, and then here's showing you, again, just a different scenario, but where that break-even point is. So the key is to just kind of be able to read those charts and understand those charts. Okay. Okay. And then here again shows you kind of a summary of when they make the change, you know, kind of what does that, it shifts that break even point to the right or to the left, again, depending on what they're doing. Then we get to our assumptions. So again, this lists out our assumptions that our total sale, again, using the charts, our total sales and our total costs are represented as straight lines. So again, like they're going up the more we sell, you know what I mean? And then the relevant range is within that what we're graphing. So we're not going to jump outside of that relevant range within the cost volume analysis that we're doing. Our costs are divided into fixed and variable components. Our sales mix is constant, and then we have no change in our inventory quantities during that period. Now, our sales mix, that says we may have break-even analysis for, you know, that we might be doing a variety of different products. So again, each product could have a different type of break-even analysis. So we're going to come up with the sales mix, knowing how much of each product that we're selling. So that's down here at the bottom. So we got product A and we got product B. They have different unit contribution margins, and we're selling different levels of them, but we're selling 80% of product A and then 20% of product B. And then there shows you that. So that for us to do a break-even analysis on those types of sales mix, we've got to know that our overall selling price is going to equal the sum of the products times their sales mix. So if the one was 20% times that sales price, this one's 80% times that sales price. And so here it shows that, so that worked out. So we've got the $90 times the 80% that we're selling, the $140 times the 20% that we're selling. So that's going to be our unit selling price of that sales mix. Then our variable cost, same thing. What was the variable cost for product A? We're selling 80% of that. Variable cost of product B, we're selling 20% of that. Add those together to get to our sales mix variable cost. So then we have a unit contribution margin of that sales mix. So it's really the same computations. We're just multiplying them by the percentages that we're selling. So whatever that percentage breakdown is. And then here again shows it put together though. So then we've got product A by itself, product B by itself, but when we combine those, we see we're covering the $200,000 of fixed costs. So we've got no gain or loss. It's just a break even. And then that's an exercise I'll let you look over. Then our operating leverage. Our operating leverage, like sometimes it's called the degree of operating leverage. We take our contribution margin and we divide it by our income from operations. So our contribution margin for Jones is the 100,000. The income is 20,000. So then we'd have a contribution margin of 5. From Wilson, we got a contribution margin of 100, income of 50. So we'd have a contribution margin of 2. So then we calculate those out to say, okay, or sorry, we'd have a degree of operating leverage of 5 and a degree of operating leverage of 2. And we use these operating leverage numbers to help us plan. So then what we do is we say, okay, well, what if our sales go up? What if we, again, are going to change our advertising campaign and we think sales are going to go up 10%? If our degree of operating leverage is 5, then that means our income from operations is going to go up 50%. So 5 times the 10% increase. If our degree of operating leverage was 2, we'd multiply that by our 10% increase and our net income would go up 20,000. So it's 20%, I'm sorry. So we're using it as a way to plan or to predict if we have changes in our sales, what does that do to our income from operations? And again, you can see the numbers of it actually kind of work out here. So that's always the nice thing, to calculate out that operating leverage and then prove it out to say, okay, if my sales go up 10%, my variable costs are also going to go up 10%. So my contribution margin goes up 10%, but then my fixed costs stay the same. So then that income goes up to 30%, not 30%, 30,000. And then you do the same thing for that Wilson. So again, if we go back though, that would be a 50% increase for Jones and then a 20% increase in their net income or their income from operations for Wilson. So then if our degree of operating leverage is high, the percentage impact on income is going to be big. If our degree of operating leverage is low, then our impact on our income is going to be smaller. And then our margin of safety is kind of like that cushion to say we want to make sure that we're not going to lose money, that we're selling enough money, and that we've got a little bit of safety in there. So we've got our current sales are 250,000. Our sales at break even are 200,000. So our margin of safety is the difference. We've got a $50,000 margin of safety. And then if our selling price is $25 a unit, we've got a 2,000 unit margin of safety. So it means we got a little bit of wiggle room there. We're still going to be able to pay all of our bills. And as long as we're working and we don't lose those 2,000 units, we should be fine. If we wanted to express that as a percent, we would take our $50,000 margin of safety and divide it by our sales and then get a percentage. Then our variable costing is also called absorption costing for doing our financial statements. So our variable costing is the things, again, that go directly up and down with our units sold. So our direct materials, our direct labor, which we've already talked about, but now we have a variable factory overhead. So a piece of our overhead that goes up and down with sales. Then we'll have a fixed factory overhead that does not go up and down with sales. And then when we're doing our income statement, that fixed factory overhead be a part of our cost of goods manufactured. It'll be more of a period expense down below in the income statement. So in our absorption costing, which is what we've had in the last chapters, when we calculated out our cost of goods sold or our cost of goods manufactured, we had our direct materials, our direct labor, and all of our overhead. Now, when we're using the variable costing, that fixed factory overhead is not included in our cost of goods manufactured. It'll be down below on the income statement. So here would be our income statement. Our sales minus our variable cost of goods sold gives us our manufacturing margin, less our variable selling and administrative expenses. So like our commission would go in that category. That gives us our contribution margin. Then we subtract out our fixed costs, our fixed manufacturing, and then our fixed selling, and that will give us our income. So then, again, here it just shows you to make the comparison. Our manufacturing margin is our sales less our variable cost of goods sold. Our contribution margin is basically, it's the manufacturing margin minus our variable selling administrative, which would then be our sales minus our variable cost of goods sold and our variable selling and administrative. And then our income from our operations is that contribution margin minus all of the fixed costs. And again, the fixed costs could be broken out by manufacturing and selling administrative as well. So then here we have an example. They sold 15,000 units, sold at a price of $50. So that would be our selling price, which is not calculated on here. Then this just shows us our variable costs. So 15,000 units at a $25 per unit variable cost, 15,000 units at a $10 fixed cost gives us our total manufacturing costs. Then we have our selling and administrative costs that are variable and fixed. So then when we're putting that into our variable income statement, let me just flip back real quick. So the $25 is what we see here in our variable cost of goods sold. Then what we show down here in our variable selling and administrative are $5 per unit. So those are here to calculate out to our contribution margin. And then our fixed cost, if I flip back there, the 150,000 that are manufacturing, and then the 50,000 that are selling administrative are grouped down here in the fixed costs. So if you look, if you kind of toggle back and forth, you see all the all the costs are there. They're just at different levels. Are they variable? Are they variable selling? And then are they fixed? And we don't care if they're manufacturing or selling. They're going to be down there in that fixed section, but we will list them out separate. Whereas our absorption, what we've done in the past, is just more basic. Sales less cost of goods sold gives us gross profit, minus our selling administrative gives us our income. So this one obviously gives us a little more detail about those costs. And then here again, it gives you a graphical kind of representation of if our units sold are less than our manufactured units, that means we have some left in our ending inventory. So we didn't sell them all. In that case, our variable costing, if we set the income statement up in a variable costing method, that income is going to be a little bit lower than the absorption costing because some of those costs are going to be hung up in our ending inventory. If our units sold are greater, we used up our inventory, like our beginning of the inventory, then it's going to flip-flop. Then we're going to have a higher income using the variable costing. But all it does is relate back to the ending inventory. So again, we have an example. They manufactured and sold 15,000 units. And then now assume that only 12,000 of those units were actually sold. So they've got the 3,000 left in their ending inventory. So we've got our 12,000 sold at the $50, our variable cost, the 15,000 that we manufactured at $25, less the 3,000 that's left in our ending inventory. So that gives us our variable cost of goods sold, and that's our manufacturing margin. Then we subtract those variable selling expenses at $5 a unit. That gives us our contribution margin. Then we subtract our fixed manufacturing costs and our fixed selling costs. So we end up with $40,000. If we were doing it our traditional method, our sales are going to be the 12,000 units at $50. But then here our ending inventory at $35 a unit has all of the costs in there. So our net income is going to be not hung up in our ending inventory, and we'll end up being able to record it all on our income statement. So again, here is just kind of explaining that those $3,000 of ending inventory include the $10 of fixed manufacturing cost. That's why the absorption income is higher. Okay.